In the year 2025, five categories of assets didn't just slow down, they bled value. And if you are still thinking money only works when prices rise, you are operating with a fairy tale brain while the financial system moves on hard rules. Here is the part nobody wants to say out loud: when asset prices fall, the winners don't freeze. They reposition, they sell, they short, they rotate, and they exploit the exact same mechanisms that trap everyone else. This is not financial advice. This is financial education. And it matters in 2026 more than ever, because the world you live in right now is getting designed around pain. AI is eating middle-class jobs faster than your career plans can adapt. Real purchasing power never fully recovered after the inflation shock. Housing prices detached from wages and never reattached the way people hoped. And the stock market keeps marching to new highs while ordinary households quietly run out of room to breathe. So when you hear five assets that will drop, understand what it really means. It means the system will funnel money somewhere else. It means your instinct to wait and hope is about to become expensive. Let me pull the curtain back with a simple question. If you can make money when something rises, why do you believe you cannot make money when it falls? Most people never ask that question because their entire financial education was built for one outcome: to keep them passive, to keep them holding whatever they already own, even when the math stops working. They taught you that growth is the only direction worth respecting. But markets do not reward respect. Markets reward behavior, and behavior changes when the price direction changes. In 2026, the script is even uglier because the consequences are now immediate. Your rent resets higher, your credit card interest compounds, your employer trims headcount or replaces roles with AI tools, your insurance premium jumps after a weather disaster that happened 2 counties away. And meanwhile, you see headlines about cooling inflation while your grocery bill keeps rising and your savings still feel stuck in mud. That mismatch between what the headlines claim and what your life experiences is the same mismatch that happens when people watch markets only in one direction, only when prices rise, only when optimism feels safe. So we are going to walk through five loss zones and the mechanism that causes them. Each time an asset category starts to fail, the money does not disappear. It rotates. It gets harvested by whoever understands the rules of money flow. And you need to understand those rules, because the default setting of the average person is to stay in the wrong place and call it long-term investing. First, let's talk about money itself, because if you misunderstand money, you misunderstand everything else. Money is not just coins or dollars or numbers in an app. Money is a promise that can be exchanged for goods and services. Money only becomes real power when it buys real stuff, at scale, across time, across borders. If a currency cannot buy what people want, or if people stop wanting it, that currency becomes a slowly decaying receipt. The dark truth is that when markets price a decline in a currency's purchasing power, assets tied to that currency's confidence get hit first. Now think like a system for a second. The United States can print dollars, it can expand its balance sheet, it can meet obligations, it can support markets during stress. That ability exists because the rest of the world accepts that dollars can buy real goods, and because the United States issues assets that the world wants to hold. Those assets have historically been U.S. Treasury securities. Treasuries are the backbone of global finance. They are the collateral for everything from banking operations to corporate financing. They are the place where safety parks itself. But safety is not a feeling. Safety is a pricing relationship, and in 2025 the relationship broke in stages. The market was essentially forced to confront a simple reality: if investors demand a higher yield, the price must adjust downward. When the Fed pushes rates and keeps them higher for longer, that doesn't just affect new borrowing, it reprices old promises. The older the promise, the more painful the repricing can be. Here is where most people get trapped. They hear the Fed is done hiking, or they hear rate cuts are coming. They assume that if the Fed shifts direction, bond yields magically fall, and the value of bonds rises like a tide coming in. But bond markets price risk based on supply and demand, not based on your hope schedule. If demand for treasuries drops, prices fall even when the Fed's policy rate later changes, and demand for treasuries can drop for reasons that have nothing to do with the Fed's press conference. For example, a country that historically held large amounts of U.S. debt may decide that it does not want to keep concentrating its reserves in a single class of promises, especially when inflation and political risk are rising. If they reduce holdings, they are essentially telling the market, "We will not bid as aggressively." That is how you get lower prices and higher yields. In 2025, people watched Treasury yields behave in a way that felt almost contradictory. Cuts were discussed, but yields stayed stubborn. The reason is brutal. If there are not enough buyers willing to accept the old terms, the market has to offer better terms to pull in buyers. Better terms mean higher yields. Higher yields mean lower prices. That is the mechanism. That is the chain reaction. Now connect this to 2026, because the bond story has consequences everywhere. When treasuries reprice, every fixed income product gets repriced too. Money market funds compete for yield. Bank deposit costs change. Mortgage rates move. Corporate credit spreads react. And even equities react through discount rates, because future cash flows get discounted more heavily when yields are higher. So the first loss zone is fixed income at the level of treasuries and everything downstream of them. If you are holding safe instruments that behave like safety, but you forget that they are still priced in a real yield environment, you can experience a value loss even while inflation is supposedly coming down. Real purchasing power is what matters, and fixed income assets can fail you when the yield regime flips faster than your plan. Second, let's talk about dividend stocks and anything that acts like a bond with a ticker symbol. Many people think equities are immune to interest rate pressure. They are not. Stocks are not magic. A stock is a claim on future cash flows. When interest rates and bond yields rise, those future cash flows become less valuable today. In plain language, the market demands a higher return to own risk. Imagine a company pays you a dividend. You might think you are collecting income while waiting for the share price to grow. But the share price is not separate from the yield equation. If the bond yield moves above what the stock effectively offers, investors reallocate. They stop paying high prices for income that now looks inferior compared to treasuries. When enough investors reprice the stock downward, you get what feels like an irrational crash. It is not irrational, it is math. And in 2025, the income assets narrative faced a reality check. When yields are higher, markets treat dividend stocks like they are overpriced until proven otherwise. Even companies with stable dividends can see their share prices fall because the discount rate moved. Now here is the pattern interrupt you need to hear. A dividend is not a shield. A dividend is a cash flow. And if the price drops faster than the dividend yield compensates, your total return can still be negative for a long time. People confuse cash flow with protection. Protection only exists when price and cash flow are aligned with the yield environment. When the environment changes, the alignment breaks. In 2026, this connects directly to your life in two ways. First, retirement planning relies heavily on the assumption that income assets stabilize your cash flow. If the price drops and the yield only partially offsets, your retirement timeline becomes more fragile. Second, AI disruption makes job income less stable for many households. People then depend more on their portfolios for bridging gaps. If those portfolios behave like income, but the share prices keep sliding, you get forced selling when you can least afford it. And that brings us to a third loss zone that most people ignore until it detonates in their face. Commercial real estate, especially in a high-rate world. This is not a headline category, it is a mechanism. Commercial real estate was already stressed by shifting work habits. During the pandemic era, remote work took off, and online shopping changed foot traffic patterns. But the real structural issue is not remote work in isolation. It is the combination of vacancy risk and financing risk. When loans mature, refinancing is required, and refinancing becomes expensive when interest rates stay high longer than markets expect. Picture a property owner. Let's name him David, because the story always sounds too abstract until you give it a human face. David is in his late 40s. He bought a mid-sized commercial building because the rent looked reliable. He did the normal thing. He assumed tenants would renew. He assumed banks would roll over debt at manageable rates. Then a wave of tenants leaves or reduces space. Suddenly, the rent coverage ratio falls. The property value expectations slide. Now the loan matures. The bank offers refinancing, but at a higher rate. David's cash flow does not suddenly grow just because the market's interest rate increased. He has to either pay the difference out of pocket or default and hand the asset back. Now multiply that scenario across entire cities. Many commercial properties have loans held by financial institutions. When property values fall and income fails to cover debt service, the loans become impaired. Banks hate impaired loans. Banks also hold treasuries and other fixed income assets, which can be affected by the same yield regime. That is how you get correlation. That is how you turn a real estate problem into a balance sheet problem. In 2025, this balance sheet collision risk increased because the world shifted from cheap money optimism into a long discipline of higher rates. The cliff appears when refinancing meets vacancy. And when the cliff arrives, it arrives fast. The cliff matters because it connects directly to the fourth loss zone, the assets and sectors that financial institutions hold as their safety buffers. When banks are forced to sell at losses, when credit risks rise, when deposit costs rise, the entire market reprices the financial sector. And you don't have to wait for a dramatic failure. You just need weaker risk appetite. This is also why you kept hearing loud whispers in market circles about banks, even when the news sounded calm. When you have a rising yield environment and property stress, the banking system can face losses from multiple angles. That can pressure earnings, and that pressure shows up in stock prices. Now, pattern interrupt again. Because this is where most viewers emotionally react the wrong way. People see a stock or a sector drop and think, but the fundamentals are fine. They assume the fundamentals are a stable reality. Fundamentals are not stable. Fundamentals include the market price of risk. Fundamentals include financing costs. Fundamentals include tenant demand. Fundamentals include liquidity. In other words, fundamentals include what investors are willing to pay today, not what accountants wrote last quarter. So far, we have loss zones tied to fixed income repricing, equity income repricing, and commercial property refinancing stress. Now we need the fourth and fifth zones, and they are not as intuitive as people want them to be. Fourth, let's talk about the US dollar itself, because nobody wants to hear that a currency can lose value even if it looks strong on a chart. But purchasing power is the real currency. A dollar that buys less is still a dollar, but it functions like a weaker one. In 2025 and into 2026, the question is not whether the United States can pay its bills. It can, with dollars. The question is whether those dollars keep their purchasing power relative to goods. That is driven by monetary expansion, fiscal deficits, and the willingness of global holders to keep financing U.S. obligations on favorable terms. When the government runs massive deficits, and when politicians promise more spending without real revenue alignment, debt grows. Global debt, by the way, is now above $300 trillion. That number is so large it becomes almost meaningless psychologically, but it matters because debt accumulation changes future choices. It can force governments to monetize, it can force central banks to manage liquidity, and it can push inflation risk into the long term. Now imagine the next time you hear a statement like, inflation has cooled. Cool does not mean fixed. Cool means slower. Your paycheck might still not keep up with the new price level. Many workers in the United States, the United Kingdom, Canada, and Australia experienced a purchasing power squeeze that did not fully unwind. Rates can stabilize while the damage lingers. And if the US dollar faces the perception of weaker purchasing power, money flows adjust. That can mean different asset classes behave differently. It can also mean that commodities and imported goods can stay expensive even when domestic conditions feel calmer. Fifth, let's talk about vehicles and other consumer durables, specifically the asset side of the energy transition. This surprises people because a car is not an investment, but it is an asset. Cars depreciate, and in a period where supply changes, subsidies change, tax rules change, and financing terms change, depreciation patterns change too. If you buy an electric vehicle and the market starts to discount new models heavily, your used vehicle becomes priced against the new supply. If new models get cheaper, used ones must adjust downward to clear the market. That is the basic rule of depreciation under competition. In 2025 and continuing into 2026, many EV makers reduced prices to maintain volume and defend market share. Meanwhile, oil prices can be influenced by production policy and geopolitical risk. If oil stays lower than expected or demand shifts, the relative advantage between fuel types changes. Consumers reevaluate, the market reprices quickly, and here is the micro story you can feel. A person named Mia, 31, works in operations. She bought a Tesla a few years ago for around $50,000 because she believed the price would hold. She wanted the savings in fuel and maintenance. She wanted the future to be cheaper. Then she checked listings. The new models got discounted. Incentives expanded and shifted. The used listings started dropping too. A car she expected to sell for maybe $35,000 after a few years now looked closer to $20,000. That is not a minor dip. That is forced capital loss. If Mia needed to sell due to job instability or relocation, she loses the money before she can recover it. Now connect this to AI and job anxiety in 2026. When employment risk rises, people postpone upgrades, but they also become vulnerable to needing cash faster. Depreciating assets hit hardest when liquidity matters. If a vehicle drops in value while your job uncertainty rises, you can't just wait it out. You sell at the wrong time. So the 5 loss zones in plain English become clear. Fixed income exposure including treasuries and the entire fixed income ladder. Dividend and high-yield equity exposure that behaves like fixed income. Commercial real estate exposure and the bank balance sheets tied to it. The currency risk and purchasing power risk that can quietly erode your standard of living. And consumer durables subject to rapid repricing, especially vehicles under an energy transition and subsidy competition. But none of this matters if you don't understand why money rotates. So now we answer the deeper question. Where does the money go when these areas bleed? It goes where the system can relabel risk as reward. It goes where assets are positioned to benefit from expansion of liquidity or policy changes. It goes where capital insiders can harvest volatility instead of being crushed by it. In earlier periods, capital flowed into treasuries as the safe place. Then, when risk perception changed, capital rotated into equities. But in a debt-driven world, the system can use asset markets to absorb money and manage the narrative. It is not necessarily evil, but it is extremely self-serving. The public sees headlines about markets rising and assumes wealth creation is happening for them. Often it is not creation, it is redistribution. Think about the US deficit. Large deficits mean money is spent beyond taxes. That spending has to be financed. Financing can come through borrowing, which can be supported by global buyers of US debt. But when global buyers reduce demand for treasuries at certain price levels, the yield must rise or the price must fall. Then the government and central bank policies respond. Policies can push liquidity into markets. Liquidity into markets often lifts the most liquid assets first. Stocks, especially mega-cap stocks. That helps certain groups more than others. If you own a diversified portfolio, you may participate. If you live paycheck to paycheck, you do not. And if you carry high-interest debt, you lose twice, once on consumption costs and again on borrowing costs. Now bring in 2026 reality about AI. AI is replacing parts of tasks, not just jobs in theory but roles in reality. Middle-class employment pipelines are narrowing. When that happens, the group that benefits from asset inflation is often different from the group that bears wage compression. Asset owners become richer in nominal terms even when the